If your child care center was negatively impacted during COVID-19, you may be eligible to retroactively claim the ERTC and FFCRA federal tax credits. The ERTC offers retroactive credit to COVID-19 affected businesses, while the FFCRA provides compensation for pandemic-related paid time off. Learn more about how to determine your eligibility, how much credit you could receive, and how to file with the IRS in this video. The information contained here has been prepared by Civitas Strategies on behalf of the New Mexico Early Childhood Education and Care Department, West, and Growing Up New Mexico, and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. In today's conversation, we will discuss the Employee Retention Tax Credit, or ERTC, and the Families First Coronavirus Response Act, or FFCRA. If your business was negatively impacted during COVID-19, you might be eligible to retroactively claim the Employee Retention Tax Credit. In this presentation, you will learn more about how to determine your eligibility and how to file. Here are some key points about the ERTC. It is easier than PPP and is payroll-based. The refund has no constraints and no forgiveness is needed. And it covers March 13th, 2020 through September 30th, 2021. There are special considerations for recovery startups. Most small businesses, including nonprofits, are eligible for the program. However, government agencies and public school districts are not eligible. The ERTC covers the period from March 13th, 2020 to September 30th, 2021. While the ERTC program ended on September 30th, 2021, you can apply for the credit for 2020 and 2021 retroactively through a simple update to your quarterly Form 941 that is submitted for all of your employees to the IRS. There is a slightly different rule for 2020 and 2021. It is important to note that in August 2021, a new criteria and process was set up for certain businesses that qualify as a recovery startup. These businesses are able to apply for the credit in both quarters 3 and 4 of 2021. The IRS filing deadline for 2020 ERTC credits is April 15th, 2024. If you are viewing this video after April 15th, 2024, you will only be able to file for 2021 ERTC credits. The filing deadline for 2021 ERTC credits is April 15th, 2025. If you have one of the following, you could be eligible for ERTC. A closure due to local or state government order. A decrease in the number of children served related to a government order. Or a decrease in revenue from 2019 to 2020 or from 2019 to 2021. The exception is PPP or FFCRA. How do you determine the quarters that qualify for ERTC? When determining eligibility for ERTC, you must first calculate the decline in revenue you had for each quarter in 2020 and 2021 compared to the same quarter in 2019. In our example, all quarters in 2019 had $100,000 gross revenue. For 2020, we do not need the calculated loss for quarter one, since ERTC did not begin until quarter two, 2020. To begin to qualify, there must be a reduction in gross wages of more than 50%. Quarter two has a reduction of 52%. Therefore, that quarter qualifies. You continue to qualify per quarter if there is a loss of income of more than 20%. In our example, quarter three has a 25% reduction and qualifies. In quarter four, there was an increase of 5%. This quarter also qualifies, as the rule states that you will receive credit for the quarter immediately following the last quarter that has a loss of 20% or more, even if there is an increase for that quarter. For 2021, the rule changes, and there only needs to be a loss of over 20% per quarter to qualify. In our 2021 example, quarter one did not have a loss of revenue compared to 2019 quarter one and does not qualify. 2021 quarter two has a 22% loss and qualifies. Quarter three has a 10% increase, but qualifies, as the rule states that you will receive credit for the quarter immediately following the last quarter that has a loss of more than 20%, even if there is an increase for that quarter. So the program ended September 30th, 2021, and quarter four does not apply. How does the ERTC benefit you? For the period beginning March 13th through December 31st, 2020, up to 50% of the $10,000 in wages per employee for the year. For 2020, per employee annual maximum is $5,000. For the period January 1st through September 30th, 2021, 70% of up to $10,000 in wages per employee per quarter. 2021 per employee quarterly maximum is $7,000, and 2021 per employee annual maximum is $21,000. Let's look at how you calculate the credit due per employee. To determine how much credit you will receive per employee, you will need a payroll report that shows each employee's gross wages by quarter for both 2020 and 2021. Your payroll company can help you with this. For 2020, you will receive a credit of 50% of gross wages per employee per quarter. In 2020, there was a maximum of $10,000 in gross wages allowed for the employee per year. In our example, we assume we have met the qualifying reduction in gross revenue for each applicable quarter. This example shows that this employee had gross wages of $5,000 for each quarter in both 2020 and 2021. Keep in mind that for 2020, only $10,000 in wages for the year per employee qualifies. In 2020, quarter one does not count, as the program begins in quarter two. For quarters 2, 3, and 4, this employee has earned a total of $15,000, but only $10,000 of that qualifies for the 50% credit. This means that for 2020, the only wages that qualify are quarter 2 and quarter 3, and there is a 50% credit for each quarter. This gives us a $2,500 credit per employee per quarter for a total credit for 2020 of $5,000. In 2021, there are two rule changes. You will now earn a 70% credit of gross wages compared to 50% in 2020. And the $10,000 limit is per quarter per employee, not per year. In our example, the employee has gross wages of $5,000 per quarter. They have not reached the $10,000 maximum per quarter, and all of their wages count for the 70% credit per quarter. For quarters 1, 2, and 3, there is a credit of $3,500 per quarter, which is 70% of $5,000 per quarter. Quarter 4 is not eligible for credit as the program ended September 30th, 2021. The $3,500 credit per employee per quarter totals a credit of $10,500 for that employee in 2021. How do you claim the benefit? You will need to keep a record for yourself showing the reduction in gross revenue per quarter for 2020 and 2021 and each employee's gross wages per quarter per year. You will keep these documents in case of an audit. You will then provide your payroll company or tax preparer with the credits you have calculated per quarter, per year. A 941X form must be filed for each quarter that you are due a credit. Due to the large number of claims being submitted, there is currently a 6 to 9 month wait before you will receive checks, which will be issued per quarter. Did you have staff who needed time off in 2020 or 2021 for COVID-19 illness, quarantining because of potential or direct COVID exposure, taking care of a family member with COVID, or taking care of their children because their child care provider or school was closed or limited to remote education? If you answered yes to any of those questions, even if they were in the past, you may be able to qualify for federal funds. We will discuss the Family First Coronavirus Response Act, or FFCRA, next. The filing deadline for 2020 FFCRA credits is April 15th, 2024. If you are viewing this video after April 15th, 2024, you will only be able to file for 2021 FFCRA credits. The filing deadline for 2021 FFCRA credits is April 15th, 2025. When the pandemic struck, many small businesses could not afford to provide the additional sick leave that would be needed due to COVID-19 related illness or quarantine. Additionally, many schools closed in reaction to the pandemic, forcing countless parents to stay home with their children and support them with remote schooling. In many cases, these small businesses lacked the reserve funds needed to pay employees whose children were now at home, leaving them unable to return to work but with no income. As such, the federal government created the Families First Coronavirus Response Act, FFCRA, leave, which provides funds in the form of payroll tax credits to help alleviate the economic impact of needing to provide this leave. Businesses have through 2024 to amend their past taxes to apply for this credit. The FFCRA covers leave taken between April 1st, 2020 and September 30th, 2021. If you have fewer than 500 employees, you can take advantage of the FFCRA, even if you are sole proprietor or self-employed and it is just you. You can take advantage of the program. Pro tip: if you have a PPP, you cannot double count the money. Make sure that the salary you are counting for the FFCRA is not the same as the PPP. For example, if you are claiming PPP forgiveness for all your salary in May 2020, you cannot also claim an FFCRA. Pro tip number 2: if you have 500 or more employees, you're not eligible to claim the credit for qualified paid sick and family leave wages. There are 2 types of leave available. Emergency Paid Sick Leave Act. First, the Emergency Paid Sick Leave Act provides up to 80 hours of sick leave for employees at their regular rate of pay, up to $511 per day, with a cap of $5,110 for the whole 80 hours. If the employee is quarantined for potential COVID-19 exposure or has COVID-19 symptoms. At 2/3 their regular rate of pay, up to $200 per day with a cap of $2,000, if the employee is caring for someone under quarantine or a child under the age of 18 whose school or child care provider is closed or unavailable for reasons related to COVID-19. A school closure includes remote learning situations where the child is at home. Emergency Family and Medical Leave Expansion Act. Second, the Emergency Family and Medical Leave Expansion Act provides up to 12 weeks of expanded family and medical leave, with 10 of those weeks paid at 2/3 the employee's regular rate of pay, up to $200 per day with a cap of $2,000. If the employee is unable to return to work, including telework, to care for a child whose school or child care provider is closed due to COVID-19. A school closure includes remote learning situations where the child is at home. You get reimbursed through a refundable tax credit. That's a technical way of saying the United States Treasury pays you using money from employment taxes. Think of this term as simply a reimbursement for the applicable wages. Reimbursement is handled differently if the employee taking the leave is a W-2 employee or a sole proprietor self-employed individual. For W-2 employees, you can get reimbursement for W-2 employees by revising past Form 941 submittals using an amendment. For sole proprietors and the self-employed, it is important to know you can claim the credit for 2020 or 2021 even if you already submitted your taxes. You will need to ask your tax preparer to file a Form 1040X and use Form 7202, credits for sick leave and family leave for certain self-employed individuals. You can also do this through the amendment process of most tax software programs. One last thing you need to know is employers may exclude healthcare providers or emergency responders from EPSLA and EFMLEA leave, and businesses with less than 50 employees can qualify for an exemption if the leave would jeopardize the viability of the business. Need more help? Visit www.crisairenm.org to find our contact information, sign up for coaching, Crisair New Mexico provider resources, ECECD recommended tools to help your business, and more. All resources are available in English and Spanish.